The 13 Fs for Q4 2023 have all been released, which means we can now see what super investors and hedge funds have been buying and selling in the stock market. This quarter was very interesting, more interesting than most. So in today's video, we are going to discuss all of the major moves the smart money is making and you need to know about. So with that being said, let's hop right into the video. And the number one thing that you are going to be seeing across social media is that Warren Buffett has started trimming down his Apple position. As we can see, Berkshire Hathaway has reduced its Apple position by 1% in the fourth quarter of 2023 and sold just over 10 million shares of Apple. This is the most interesting move of the entire quarter because Apple is Berkshire's number one stock holding. It makes up over 50% of Berkshire's portfolio now. So seeing Berkshire trim down Apple is unusual. And personally, I did believe that this was a stock that Warren Buffett and Berkshire Hathaway were going to want to own forever and basically would never consider selling. So I don't know what the full motive is here behind the Berkshire sell, but in this video, let's discuss some potential possibilities here. So the first thing that I want to discuss is when Berkshire acquired Allegheny, which is an insurance company, I believe Allegheny had shares of Apple. And then when Berkshire acquired Allegheny, Berkshire's net Apple position increased and they had to report that as an increase to its Apple position in its stock portfolio. This made it look like Berkshire was continuing to increase its Apple position, but it didn't actually buy Apple shares. It acquired a business that held Apple shares. So what could be happening this quarter is the same thing, but in reverse. If Berkshire sold off some sort of business that held Apple shares, then maybe Berkshire's entire Apple position could have decreased through them selling that business. So maybe it's something similar to that, or maybe Buffett has a limit to how large he wants his Apple position to get as a percentage of Berkshire's total assets. That could also be another explanation here where they're just simply trying to lower their net Apple position on the balance sheet. And that's kind of my thinking here, to be completely honest with you, because again, I really don't see Buffett or Berkshire wanting to sell out of Apple at all. However, I like to consider both sides of the argument, so let's discuss why Berkshire may be selling down its Apple position or trimming it down, because I do think that the stock is actually quite expensive today. If we head over to Stock Unlock and we take a look at Apple's price to free cash flow all the way back here until about 2010, we can see that it is trading for a price to free cash flow of about 27 today. And based on Apple's history, this is around the highest price ratio that the business has sold for over the past 14 years now. So Apple's stock is definitely not cheap in the stock market today. And what's also interesting is if we take a look at Apple's revenue and its free cash flow here, we can see that they have been topping out since about the end of 2021 now. So over the past about 2 to 3 years now, Apple's revenue and free cash flow hasn't really been growing that much. What this ultimately means is that Apple is trading for its highest price ratios in about 14 years, at the same time as the business is not really growing right now. So that combination right there does ultimately make Apple stock look quite expensive. However, there also has been periods throughout Apple's history where its revenues and cash flows haven't grown for a few years. For example, this period from 2018 to 2020 saw Apple's revenue not grow at all, and then it had a massive surge in revenue, and now it's kind of plateauing once again. So this is kind of Apple's business that go through really rapid growth periods and then kind of level off and then go through another really rapid growth period. So if Apple is about to enter another really rapid growth period, then maybe that could justify the high price today. However, I am not as optimistic that Apple is about to see a massive surge in growth. So to me personally, I do think that Apple stock is looking quite expensive today. And who knows, maybe that is one of the reasons why Berkshire is selling down its Apple position. I also study Warren Buffett's investment philosophy and I try to follow it as best as I can here on my channel. So what Warren Buffett does is he always takes a look at what the business behind the stock can generate and return to him as a shareholder, and he looks at the business as if he owns the entire thing. So when we look at how much cash Apple's business is actually generating and can return to shareholders right now, it's only about 3.7%. That is its free cash flow yield, which in my opinion is the best metric that shows you how much cash a business can return to you. Now, in my opinion, a 3.7% free cash flow yield on a business that is not really growing right now is not a very good return on that investment. So this could also be the thinking of Berkshire Hathaway and Warren Buffett. And let me know down in the comment section why you think Berkshire Hathaway is trimming down its Apple position right now and what your theories are, because I could see this on both sides, to be completely honest. Now, another very interesting move from Warren Buffett and Berkshire Hathaway is that it is continuing to buy Occidental Petroleum and increased its position by nearly 9% in the quarter. Occidental Petroleum is now over 4% of Berkshire Hathaway's entire portfolio, so this is becoming a large position for Berkshire. and they are continuing to add to their Occidental overall position. Now, if we take a quick look at Occidental today, we can see that its price to free cash flow is only 7.6, which means that this business has a free cash flow yield of 13%. Now, using that same Warren Buffett logic of taking a look at how much cash the business behind the stock can actually generate for you as the investor, the answer to that question on Occidental today is about 13% on its market cap. What this means is that if Occidental Petroleum wanted to pay out 100% of its free cash flow as a dividend to shareholders, then it could pay out a 13% dividend yield right now, which is a yield that exceeds the historical returns of the S&P 500. So when you take a look at how much cash Occidental Petroleum's business can deliver to you, it's actually a pretty significant amount relative to the company's price today. Now, I also know that Occidental Petroleum is using its large amounts of free cash flow to lower its total liabilities and reduce its debt. And here we can see that its total liabilities have declined from 125 billion in the third quarter of 2019 to about $72 billion today. So it has reduced its total liabilities by over $50 billion in the past about 5 years now. And the company's business plan has been that when its total liabilities and its debt is reduced to a very sustainable level that the business is comfortable with, then it is going to start diverting all of its free cash flow to buying back shares and increasing the dividend. And when Warren Buffett read this investment strategy and this capital allocation strategy, he said that he agreed with it, and that is when he purchased the stock. So I do see why Warren Buffett owns this business, and he must believe in the long-term cash generation potential of Occidental Petroleum and the overall business's moat. Basically, it seems like Warren Buffett believes that Occidental Petroleum is going to be able to continue generating this level of cash flow over the long term and delivering it back to shareholders through increasing the dividend and buying back shares. So Occidental Petroleum provides a really good contrasting example of Apple today, because again, Apple only has a 3.7% free cash flow yield, whereas Occidental has a 13% free cash flow yield. So you can clearly see why Berkshire and Warren Buffett may be buying one stock and selling the other, because one has a very low yield and one has a very high yield today. And that is kind of how I believe Warren Buffett looks at his investments and thinks about them. But again, let me know what you think down in the comment section below, and I will be responding to comments because this one is very interesting to me as well. But now let's move on to Michael Burry's portfolio. And he made some interesting buys here of Alibaba and JD. And he increased his position by 50% in Alibaba and 60% in JD. And these two positions are now the largest positions in Michael Burry's portfolio. So he seems to be buying the dip on Chinese stocks, and he seems to believe that there is value there. But honestly, Michael Burry is not someone that I pay much attention to. His investment style and him being a perma bear on the overall market and him seeming to turn over his entire portfolio every 6 months just doesn't resonate well with me. And to be honest, I don't really know why people pay so much attention to Michael Burry's portfolio and what this guy is doing in his portfolio. He just seems all over the place. And yes, he increased his position in Alibaba and JD in the fourth quarter of 2023, but who knows? This guy could have already turned around and sold out of all of these positions. So again, personally, I do not place a lot of weight on what Michael Burry does, but I do know that a lot of people pay attention to what Michael Burry does. So just for the sake of other people's interest, yes, he has purchased more Alibaba and JD in this quarter, and it does look like he is continuing to buy the dip on Chinese stocks. Now, what's also interesting is David Tepper, who is a multi-billionaire and said to be worth over $20 billion, and also manages the Appaloosa Fund, which has $5.6 billion in assets under management, has also been buying Alibaba and increasing the overall fund's position in Alibaba. Here we can see that David Tepper increased his Alibaba position by about 21%, and now it makes up 6% of the Appaloosa portfolio, with a total worth of $337 million. So this is pretty large conviction in Alibaba as well, and that's actually a pretty significant increase to the position, which now makes Alibaba, I believe it's the 6th largest position in this multi-billion-dollar portfolio. Now, what's also interesting is the Canada Pension Plan Investment Board acquired 3.6 million shares of Alibaba in the fourth quarter, which is a total value of about $300 million. So Canada's pension plan is also starting to invest more money in Alibaba and continue buying more Alibaba shares. And this is another pretty significant position of, again, $300 million. Now, the next super investor is Howard Marks, which is someone I highly respect and a super investor that I follow closely. I also love Howard Marks' books. Now, what's interesting is Howard Marks has added to his JD position and has started a position in Alibaba. Now, the Alibaba position is pretty small at 0.17% of the Oaktree portfolio, And JD is also 0.25% of the Oak Tree portfolio. So these aren't massive conviction holdings or buys for Howard Marks, at least in my opinion. But there still is only one reason why you would buy its stock, and that is because you believe it is cheap and its stock price is going to go up over the long term. So Howard Marks clearly believes that JD and Alibaba are cheap today, and that these stocks are going to go up over the long term. Howard Marks is also known for being a contrarian investor and looking for value in places in the market where other investors are extremely bearish on or not optimistic about. And I believe that the pessimism towards Chinese stocks is at an all-time high right now. These stocks are as cheap as they have ever been, and I believe that Howard Marks is looking at this and saying, hey, these stocks look cheap, I'm going to take advantage of that and start buying them. And again, this is what Howard Marks is known for. I also found a recent video of Howard Marks discussing what he thinks about China and the overall Chinese economy right now. So I'm going to play this video very quickly. It's less than a minute, and then we will discuss it afterward.
But what I think is this: China is nothing short of an economic miracle. From 1979, over the next 40, I think it was 40, maybe 41, 42 years, they increased the GDP 100x. It went from 177 billion to 17.8 trillion. And 100x on GDP in a short period of time, it's a miracle. They moved tens of millions of people from the farms to the cities and from subsistence agriculture to manufacturing. And I think they want to keep doing that.
So in this video, Howard Marks is clearly saying that he is bullish on China over the long term, and what this country has done to its overall economy is nothing short of a miracle. And clearly, China wants to continue growing its GDP. It is not going to just throw in the towel and say, hey, we did it, let's just stop trying to grow right now. They're obviously going through some problems right now, like every economy does once in a while, but I do believe that China is going to figure it out. And I agree with Howard Marks that they probably do want to continue growing their economy over the long term, and they have every incentive to want to continue growing it. So I completely agree with Howard Marks, and I do see why he is adding to JD and started a position in Alibaba. Then the question becomes, why are all of these super investors and hedge funds buying Alibaba and JD today? Well, on my channel recently, I did a full video dedicated to covering Alibaba's Q4 2023 earnings report and explaining why I believe that the stock is cheap today. So in this video, let me just very quickly summarize my thoughts for those of you who may be new here. Alibaba is trading for a price to free cash flow of about 8 today, which is a free cash flow yield of about 13%. Now, going back to how Warren Buffett thinks about his investments and taking a look at the yield on the cost of the shares today, this is a similar yield to Occidental Petroleum, again near that 13%. This again means that if Alibaba wanted to pay out 100% of its free cash flow as a dividend to its shareholders, then it could pay roughly 13% right now, which is above the S&P 500's historical returns. So this business doesn't even really need to grow its free cash flows at its current price to deliver a large return to its shareholders. All it needs to do is maintain its free cash flow and then return that free cash flow to its investors, and they will get a solid return on it. However, Alibaba obviously wants to continue growing its business over the long term, and the new CEO has made it pretty clear that the business wants to refocus on its core and sell off all of its underperforming business units. Basically, the CEO believes that the business got too wide and it's in too many industries now that are unprofitable. So it wants to cut off all of the fat, cut off all of the unprofitable business segments, and then refocus the business back on its core and its actual cash generating business units, while also still growing the business internationally. And Alibaba did grow its international business unit by 44% over the past year, which is pretty significant growth. So I personally believe that Alibaba is going through its year of efficiency, which is like what Meta went through in 2023. Now, I'm not trying to compare Meta and Alibaba. I believe that Meta is a significantly higher quality business than Alibaba. All I am trying to say is that it seems like Alibaba is taking a page from Meta's playbook, and they're trying to refocus on the core and increase the efficiency, and then overall get the company's profitability, its margins, and its cash generation back up. So over the long term, I do believe that Alibaba is going to continue to grow its free cash flows and that overall free cash flow yield on cost today. Now, additionally, I went through JP Morgan's guide to the markets that they put out every single quarter, which is an overall view on the US markets and international markets, and I found some interesting things that could further explain why investors are investing in international markets right now. So right here, this chart on the left-hand side shows us the deviation between the US market's valuation and the all world index valuation. So basically the US market's valuation versus the rest of the world or international markets. And here we can see that the valuation gap is the widest it has been in 20 years, with a 34% difference in the valuation of the US market and international markets. The US market is currently trading for a forward price to earnings ratio of 19.5 versus the all world index or international markets of about 12.9. So there is a wide discrepancy in the valuation of the US market and international markets. The US markets are also selling above their historical average price ratios, while the international markets are selling below. So these investors that are trying to find value right now are probably finding that value in the international markets. This next slide right here shows us the valuation of the US market versus China. So China's current price to earnings ratio is 9.3, which is pretty dang low. It's well below the country's historical average. However, the US market again is at that 19.5, which is clearly above its historical average of about 17. So again, the US market looks like it is arguably overvalued right now or expensive, and then the Chinese market in specific looks like it is quite cheap. It's actually the cheapest out of the emerging markets, Europe and Japan, by far. Now, what's also interesting is the US GDP is projected to grow by about 2% annually out to 2028, whereas China's GDP is projected to grow at almost double the growth rate over the next 5 years. So China's market is priced at almost half of the US market, despite the overall economy projected to grow almost twice as quickly. So again, I can see why investors may be finding value in Chinese stocks in specific, and at least in the international markets right now. Now, lastly, let's take a look at the top stocks that super investors have been selling in the third quarter of 2023. And here we can see that Microsoft was the #1 top sold stock, with 22 super investors and hedge funds selling Microsoft stock or trimming it down in the fourth quarter. Next, we have Alphabet, Meta, Alphabet again, and then Amazon. So what I am noticing here is it seems like super investors and hedge funds are trimming down their tech positions. And this also kind of does make sense to me, because tech has been what has been guiding the market up over the past year. And on my channel, I have been especially saying that I believe that Microsoft is quite overvalued right now, and that I do believe its future returns over the next 5 to 10 years could be quite low. So I can see why super investors and hedge funds may be trimming down their tech positions. Now, I also found this right here, which shows us the sectors that super investors are trimming down and selling off right now. And #1 is technology. So smart money is clearly trimming down technology. But then my question is, where is that money going? And this screenshot right here shows us that the #1 sector that smart money is buying right now is financials and then healthcare. So it seems like they overall on a net basis are trimming down technology and adding to financials and healthcare. So if you are an investor looking for value, then maybe you can find it in financials and healthcare stocks right now. But overall, that is what super investors are doing in their portfolios. Again, there was some pretty interesting activity in this quarter, with Berkshire selling off Apple or trimming down its Apple position, and then a lot of different super investors and hedge funds adding to Alibaba and JD, which are Chinese stocks. So let me know what you think down in the comment section below, and let me know if you enjoyed this video. If you did enjoy this video, then please remember to leave a like on it, as it does really help out my channel. And if by chance you're new here, then please consider subscribing to my channel as well. Also, if you want to learn fundamental stock analysis, as I do here on my channel, then you can check out my book, The Fundamentals of Investing, on Amazon, which is now a #1 bestseller and has been getting a lot of great reviews. This book is incredible for someone who is new to investing or wants to learn more about how to analyze stocks and value stocks in the market. And again, The Fundamentals of Investing is now available on Amazon worldwide, so make sure to go and check it out. But with all that being said, thank you all so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.